Money isn't just earned. It's controlled by rules most people never learn. The rich know them, and by the end of this video, you can too. You see, the financial system rewards knowledge, not just effort. It's a hard truth, but you can work tirelessly your whole life and still end up with very little to show for it if you don't understand the game. It's like trying to win at chess without knowing how the pieces move. So, let's learn the rules. Rule number 1, money follows value, not time. Most people are taught to trade their time for a paycheck. You work an hour, you get paid for an hour. But the wealthy understand that this is a trap. Instead, they trade value for money. They create a product, a service, or a system that solves a problem. That value can then be sold over and over again, earning them money even while they sleep. Think about it. A musician creates a song once, but gets paid every time it's streamed. An author writes a book once, but earns royalties for years. Your goal should be to detach your income from the hours you work. What value can you create that people are willing to pay for? The second hidden rule is that cash flow beats income. A high salary looks impressive, but it has a fundamental weakness. It stops the moment you stop working. Whether you're a doctor or a janitor, if you're not on the clock, you're not earning. Cash flow, on the other hand, is income that keeps coming in, regardless of whether you show up to an office. This is the holy grail of financial freedom. It comes from assets, things you own that generate money. Think of rental income from a property, dividends from stocks, or royalties from a creative work. These streams keep flowing, creating a stable financial foundation. Building cash flow isn't about getting rich quick. It's about building a system that pays you month after month, year after year. Next up, rule number 3, and this one is a mind bender. Money is debt in disguise. When you hold $1, you're actually holding an IOU from the central bank. The entire modern financial system is built on debt. Banks create money out of thin air when they issue loans. Understanding this changes everything. Instead of being a perpetual borrower, paying interest your whole life on credit cards and car loans, you can flip the script. You can become the lender. By investing your money, you are essentially lending it to companies or governments, and in return, you collect interest or profits. You start playing the bank's game, and that's a game you want to be on the winning side of. Rule 4. Taxes reward ownership. This is a big one. The tax system is not designed to be fair. It's designed to incentivize certain behaviors. Employees who simply trade their time for a wage are often taxed at the highest rates. Why? Because the system is structured to reward those who create economic activity, the owners. Business owners and investors enjoy numerous tax advantages because they're the ones creating jobs, building companies, and funding innovation. When you own a business or invest in assets, you can legally deduct expenses, depreciate assets, and benefit from lower tax rates on capital gains. The message is clear. If you want to keep more of your money, transition from just earning it to owning the things that produce it. Which brings us to Rule 5. Inflation punishes savers. You've been told your whole life to save your money, and it feels like the responsible thing to do. But here's the problem. Cash is not a safe investment. Every year, inflation silently eats away at its purchasing power. That $100 bill in your wallet buys less and less over time. It's a silent thief. The wealthy know this. They don't hoard cash. They convert it into assets that can outpace inflation. These are things like real estate, stocks, and commodities like gold. These assets don't just sit there. They have the potential to grow in value, protecting and increasing your wealth while everyone else's savings are shrinking. Rule 6 is about mastering a powerful tool. The rich use debt as a tool, not a trap. There are 2 kinds of debt: bad debt and good debt. Bad debt is what most people are familiar with, using credit cards to buy consumer goods, or taking out expensive loans for depreciating assets like cars. It's borrowing to fund a lifestyle. Good debt, on the other hand, is borrowing to acquire assets that will generate more income. The wealthy leverage other people's money to grow their own wealth. For example, they might take out a loan to buy a rental property. The rent from that property covers the mortgage payment and then some, creating positive cash flow. They've used debt to buy an income-producing asset, and that's how you build wealth strategically. And finally, rule number 7, perhaps the most important of all, emotions destroy wealth. The financial markets are driven by two powerful emotions, fear and greed. Fear causes people to panic and sell at the bottom of a market crash, locking in their losses. Greed causes them to buy into a bubble at its peak, right before it bursts. The most successful investors are not the smartest but the most disciplined. They have a strategy, and they stick to it, regardless of the daily noise. They understand that wealth is built over the long term. By controlling your emotions, you can avoid the costly mistakes that derail most people and stay on the path to financial success. So, let's recap the 7 hidden rules. Trade value for money, not time. Build consistent cash flow. Understand money as debt and become a lender. Own assets to get tax advantages. Invest to beat inflation. Use good debt as leverage. And master your emotions to win the long game. These are the laws that the wealthy live by. The money game isn't always fair, but it is absolutely learnable. Once you know the rules, you can stop being a pawn and start playing to win. Reese from Powerful Individual would like to thank you for watching. If you found this valuable, please subscribe and hit that like button to join us on the path to financial mastery. We'll see you in the next video.